Welcome to Policy on Demand. I'm Nita Asher, and I'm thrilled to be filming from our Tax Leadership Conference and to be here with my colleagues, Neil Edwards and Nils Cousin. Thank you so much for being here.
Of course. Thanks, Nita.
On this Policy on Demand, we're going to focus on some treaty developments as well as certain technical issues that are facing certain inbound companies. And with that, we're going to start off with treaties. Nils, there appears to be bipartisan interest in negotiating new treaties and ratifying some certain stalled treaties. Can you elaborate on what's going on in the treaty landscape?
Sure. So first, with respect to existing treaties that have been signed and have not yet been ratified, there are still 4 treaties that are out there that have been out there for about a decade, with a particular senator placing a hold on the ratification process. There is definitely bipartisan support for moving those treaties forward, but as a result of the 2017 tax reform taking place in the interim time between those treaties being signed and now, there need to be some renegotiations to make sure that the treaties properly address our base erosion alternative minimum tax, and that process is ongoing. So while there's interest in moving those treaties forward, I think we still have a little bit of time to wait until they are in fact ratified. Now, at the same time, we're seeing a renewed interest in Treasury in renegotiating some existing treaties. One that I think is very important and that a lot of people pay attention to is the treaty that we have with Switzerland. So obviously Switzerland is a key trading partner, and a lot of multinational companies have a base of operations there. There's a really significant interest, I think, in a lot of the international community in renegotiating that treaty with a view of adding a potential 0% rate for parent subsidiary dividends, which we have that in a number of treaties with EU countries. We don't have it in the current Swiss treaty. But part of that negotiation process is that the US now has a model treaty that was published in 2016 that in a number of respects is more complicated than the prior model. And so I think what a lot of people are waiting to see is how these negotiations go on, and at what point will we see a negotiated treaty, and to what extent will it pick up on the 2016 model treaty versus some of the existing treaties.
It's very interesting. Also, with the termination of the Hungary treaty, what are you hearing from companies about that, and where are the tension points?
Sure. So we have currently a treaty with Hungary, an existing treaty that's quite old and does not have a limitation on benefits article. There is a treaty that has been a new treaty that's been signed. It's actually one of the 4 that is stalled right now. But earlier this year, the U.S. announced its intention to terminate the existing treaty with Hungary. What that means, that termination process takes a while, but what it ultimately means is if it takes place as expected and if the new treaty isn't ratified, the U.S.-Hungary treaty will cease to be in force at the end of 2023. So, there are companies that have operations in Hungary, that have used the Hungarian treaty, that have always thought, well, I have to sort of keep an eye on what's going to happen with the Hungary treaty as the new one will get ratified, because it'll have a limitation on benefits article, which is not in the current treaty. But now, of course, they're having to think about whether, if they have, let's say, intercompany financing structures or things like that, where Hungary is involved, whether those are not going to be viable anymore, and they'll have to move to something else. Of course, the advantage of it being there until the end of 23 is, clients certainly have ample time to figure out what they're going to do. And of course, that also presents ample time for other things to potentially happen, right? A termination could be rescinded, but we still have this signed pending new treaty out there that could also, in theory, still get ratified.
It's very helpful. Before we move away from treaties, just briefly on the FTC regulations, they have definitely, the I guess interest in treaties from a foreign tax credit perspective has increased in view of certain provisions in the FTC regulations. Can you expand upon that?
Yeah, and I could sort of make a bit of a personal story of myself. I'm a treaty person. I don't really do FTC work, but these new FTC regs that got released several months ago, I think make it in a lot of ways more difficult for a foreign tax to be creditable, unless it is a foreign tax that's cover tax under an income tax treaty. And so where I didn't really do much with FTCs before, suddenly as a treaty person, now a lot of folks are looking at these taxes that they're paying to foreign countries, and having to start looking at the treaty. Is this a cover tax under the treaty? What does the treaty's relief from double taxation article say? And so that's become a much more critical part of whether you can credit a foreign tax than it used to be.
It's a very helpful summary. Now, bringing Neil into the discussion. Neil, you and I had a lot of discussions about the proposed changes to the BEAT under Build Back Better. Those changes were not enacted into law. What questions are you getting from foreign parented groups about, the BEAT and the scheduled change to the BEAT rate that will occur at the end of 2025, absent any legislative changes?
Yeah, so I think that, the BEAT rate going up is always felt like it was a long time away, and it's still a little bit off, but certainly that's concerning for people. And I think with the changes not going through, one of the particular changes that was proposed that was generally thought to be really taxpayer friendly was this idea that you would get carved out of the BEAT if you had a payment that was picked up at an appropriate tax rate overseas. And with Pillar 2 coming on board now, such that, effectively globally, all corporations are going to be subject to a minimum 15% tax rate. The question becomes, well, what happened to that provision? And why is it appropriate that I should be, subject to BEAT on payments in the US when they're subject to at least a 15%, if not higher rate, in the foreign parent? But, unfortunately, there was kind of bad news that could have come from those proposals going through in terms of the expansion of the rules to cost of goods sold payments. But, we didn't get the good news either. So that's certainly something that keeps coming up.
Absolutely. And then also certain TCJA changes, the changes to Section 174 and the changes to 163J. It's unclear if we'll even know what's going to happen with the midterm elections until December. And so we don't know if there's going to be any sort of extenders package that will address Section 174 or 163J. In the meantime, what questions are you getting from your clients trying to manage the uncertainty with respect to these provisions, or the fact that there is some certainty what is current law, absent any legislative action?
That's right. So companies are working on the basis that they're going to have to capitalize 174 under 174, and also the depreciation and amortization add back is being taken away from ATI, and that's under current law, as you said, in effect for the current tax year. There's still questions keep coming. Are we going to get this kind of extension or the deferral of those provisions? And we still hope to see that, but when are we going to get it in time for our end of year financial statements? How might it affect our accounting for those things? And so those points are still outstanding.
And I guess there's still an emphasis on the quantitative analysis, because the capitalization of 174, it hurts in a lot of aspects, but does potentially help, let's say, with your BEAT calculation, depending on where those expenses are. And so just the interest in quantifying, what the law is or what the law might be changed to remains important.
That's right.
Yep.
BEAT is all about modeling. And some of these timing differences can be helpful, like you say. If you don't get the deduction now, or taxable income goes up to a higher number, that potentially just lifts you out of BEAT. So some people, affirmatively been trying to capitalize some of these expenses just to kind of push BEAT down the road. And the one other thing I was going to mention on the 163J that also keeps coming up is this lack of conformity with the international norm. Like the 30% is the rule. Consistently, we've seen from other OECD countries, but it's always been EBITDA. So like, why is the US rule less favorable? That keeps coming up as well. And as we said, hopefully there'll be a kind of extension of that policy that allows the direct back.
That's an interesting and fair point. Thank you so much for being here, Nils and Neil. I truly appreciate it. And thank you for joining us on Policy on Demand. Apologies for the background noise. Once again, we're filming at our Tax Leadership Conference, but I appreciate you all tuning in. Thank you.